Have you ever had that feeling? You know the one, where it seems like the market knows exactly where your stop loss is and just hunts it down for sport. Well, today we're going to break down exactly why that happens and show you a systematic way to trade market reversals. Trust me, this isn't about luck. It's about understanding the game. Let's get into it.
I mean, it's got to be one of the most frustrating experiences in trading, right? You do all your homework, you pick a direction, you set what you think is a perfectly safe stop loss, and then boom, price wicks you out by a hair before rocketing off in the exact direction you said it would. It feels personal, it really does. But here's the thing, it's not. It's structural.
And this quote right here, it gets to the heart of a much deeper truth about the market. See, it's not just you against the charts. It's really a battle for liquidity. And the big players, the institutions, they have a massive, massive advantage. So understanding their game, that's the very first step to turning the tables.
All right, let's kick things off with Section 1, the market maker's game. Before we can even talk strategy, we have to understand the why behind all these frustrating moves. What forces are really pushing prices around? Because I promise you, it's not as random as it looks.
So, who exactly are these market makers? Well, think of them as the puppet masters of the financial world. We're talking about massive institutions with enough capital to literally engineer price moves. To them, all our little stop-loss orders clumped together on the chart, that's just a big pool of liquidity. It's like a gas station for them to fuel their gigantic positions. Your stop-loss isn't just your protection, it's their target.
So how do we stop being the fuel for their fire? Well, we start by seeing the market the way they do, from the top down. We need to zoom out and get the big picture to figure out the true underlying trend.
This top-down approach is the absolute foundation of this whole strategy. Seriously, think of the daily chart as your compass. It tells you which way is north for the week. If that daily chart is bullish, you should only be looking for reasons to buy. The 4-hour and 1-hour charts? Those are just your magnifying glass, helping you pinpoint the best possible entry zones. Trying to trade against that daily trend is like trying to swim up a waterfall. You might fight for a bit, but you know how it's going to end.
Okay, now we're getting to the real heart of the strategy. How do we spot the exact moment a trend might be about to reverse? This, my friends, is where something called the change of character, or CHoCh, comes into play.
Now, before we can spot a change, we got to know what a healthy trend actually looks like, right? So, in an uptrend, price is making a nice, clean series of higher highs and higher lows. That last support in the market is simply the last significant low point before the newest high was made. That level is the line in the sand. As long as the price stays above it, the bulls are still in charge.
Now, listen up, because this is probably the single most important rule of this entire system. A single little price spike or a wick below that support level, that's not enough. That's a classic trap designed to fool you. To confirm a real change of character, we absolutely need to see count them, two consecutive candle bodies close below that level. No exceptions. This rule right here is what separates a genuine reversal from a costly fakeout.
Okay, so this slide just lays it out perfectly, the difference between real conviction and a trap. Look on the left, that's a valid chart. See how the first candle closes below and the very next one also closes below? The trend is broken. Now look on the right, that's the fakeout. The first candle closes below, luring sellers into the market, but the very next candle immediately rips back up and closes above the level. That is a textbook liquidity grab, designed to trap sellers before the price goes higher. That two-candle rule is your shield against this kind of thing.
And once that bearish CHoCH is conferred, the whole game flips. We completely stop looking for buys, and we start hunting for sells. And the best part is, that bullish structure that was just broken, it now gives us 3 potential high-probability zones to look for a sell entry. The old support becomes new resistance, we get this optimal A+ level, and the old high becomes a potential double top. The market literally gives you a roadmap.
All right, Section 4, reading advanced signals. The standard CHoCH is our bread and butter, but now let's level up and look at a couple of advanced variations that can give you an even earlier heads up.
You know, sometimes waiting for a change of character on a high time frame like the daily chart can feel like watching paint dry. That's where the 5-wave shift comes in. It's an advanced pattern that can give you a really early warning. It's a series of 5 smaller waves that forms inside the last big move of the main trend. If you spot this taking shape, it's a huge clue that the big money is starting to unload their positions and a major reversal could be right around the corner.
Now this next one. It's a bit of a unicorn. It's rare, but when you see it, wow, is it powerful. A dual change of character is when a perfectly valid reversal signal fails in the most spectacular way possible. So imagine you get that confirmed 2-candle bearish CHoCH, but instead of price dropping, it just explodes upward and breaks the previous high. This is the market's ultimate fakeout, and it's an incredibly strong signal that the original trend is about to resume with a ton of force.
Okay, Section 5, Safe versus Risk Entry. So you've done the work, you've identified a fantastic potential setup. Now for the million-dollar question. How do you actually get in the trade?
You've really got two main choices here, and it all boils down to your trading style. The safe entry. This is for the patient trader. You wait for the price to come into your zone, then you zoom into a lower time frame, like the 1 minute, and wait for a mini CHoCH there for extra confirmation. Then you have the risk entry. This is for the more aggressive trader who wants a better price. You enter as soon as a key level is swept, without waiting for any confirmation. It's definitely higher risk, but the potential reward is much greater. There's no right or wrong answer here. It's all about what fits your personality.
All right, let's bring it all home. Section 6, the trader's framework. This isn't just a bunch of random rules, it's a complete logical framework for reading the market.
Look, it all boils down to this. If you can truly master these 3 core concepts, you've pretty much mastered 80% of this entire approach. Number 1, correctly marking market structure. Number 2, identifying a valid change of character. And number 3, doing it all through the lens of multi-time frame analysis. Everything else we talked about is just confirmation. These 3 pillars, they are the engine that will drive every single one of your trading decisions.
And that brings us to the most important question of all, one you really need to ask yourself. Are you trading with a system, or are you just gambling? Are your trades based on a clear set of rules and logic, or are they based on hope and fear? The big institutions, they prey on emotional decision-making. By trading with a clear framework like this one, you start to take the emotion out of the equation, and you start to trade like a professional.